You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well today. I wanted to come back on this, good news and bad news at the same time, where Bank of Canada cut their rate for the second time. And ironically, our government was super proud about that, being the first of the G7 countries to cut their rate not too long ago, and then the first countries of the G7 to cut their rate a second time. Which is kind of ironic because this is good news and bad news at the same time, and we're going to do a deep dive on this today. First, always get the facts straight and then start thinking by yourself instead of having somebody else telling you what is good and what is bad. Just because sometimes we read stuff and it simply doesn't make any sense. So while the Canadian government on a tweet from Mrs. Freeland was saying that it was due to her hard work and her economic plan is working out, and this is why we're able to drop the rate. Well, when a central bank drops interest rate, that means that the economy is slowing down. This is literally the way that they play with the interest rate to kind of monetary control inflation, but also the pace of the economy. Because as a country, you do not want to have an economy on fire for too long because it will generate inflation. So if everybody's working and if everybody's making more money and all companies are selling more stuff at a bigger price, well, then people start asking for pay raise, which makes sense, and then companies are selling at a higher price, and then you get inflation. So you don't necessarily want to have people rushing through stores and buying everything they want at all time for several years, because then you're going to have the other kind of problem. So you're using the interest rate to kind of put some gas or put some brake on your car, and your car being the economy. So when you are cutting down rates, you're trying to give some room for the economy to grow because you can see that there's a slowing down. So we're going to start with the good news because I'm a positive guy. So it's good news, of course, if you have a mortgage or if you're in debt, because your debt just dropped by 25 basis points if you're on a variable rate. And if you have to renew your mortgage, it's going to be a little bit lower down the road this year. So that's, of course, good news. Another thing it's a good news for is, inflation is getting under control. And this is also one thing that we kind of have to celebrate because it's been a very uphill, long, difficult battle to tame that inflation since 2021. So now we're back to 2.7%. The target rate is 2%. So we are getting there, but we are also getting a clear sign that the inflation rates is slowing down almost months after months on a steady basis. This is what the Bank of Canada wanted to see. The other good news, and don't worry, we're going to have plenty of bad news after that, but the other good news is hopefully it's going to help a little bit stocks in your portfolio such as Enbridge, TC Energy, BCE, TELUS, REITs, utilities as well, because all of those companies, they use a lot of leverage, meaning that they use a lot of debt, and because they are capital intensive, they require billions to maintain their infrastructure and to grow their projects. And this is quite costly when interest rates are rising. So now that we have seen 2 interest rate cuts, it should help them a little bit. On both sides, don't expect major movements on those companies because most of them, they have a strong management team, and therefore most of their debt was in fixed rate, and it was the expiration dates were spread throughout many years. So while the interest rates today is changing, if they have to renew a big debenture in 5 years from now, it has pretty much very little impact because it's going to either go up or go down in the next 5 years, but they do not necessarily want to renew that right away. So for that reason, it was not a catastrophe to see the interest rate rising over the past 2 years. I mean, over the long run, it is. But now that it's going back down, it's not going to put a major push for them. But still, I mean, it's better than nothing, right? This is what we want to see over the long run for those investments, to try to get some love from the market and some new air to breathe, which is just good news. Now, unfortunately, a lot of bad news. Well, first of all, going back to that comment of, oh, we are the first of the G7 countries to cut our rates twice this year. I mean, is it really congratulations that we have to say when you look at other data where we have a weaker dollar now, and chances are it's going to continue to weaken unless all the other countries are experiencing an economy slowdown. But in the meantime, our dollar was weak, still weak. We're trading at like what? Like a US dollar is now worth like $1.38 now. Will we see the day that it's going to go up to 140? Well, it is possible. And I mean, between you and me, I just came back from Iceland and I felt that conversion rate was not great. So anyways, so that's one thing. The second thing is another reason why the Bank of Canada decided to cut the interest rate was the unemployment rate is actually increasing. So people are starting to lose their job. It's starting to get more difficult to have a new job. So the moment, and I remember like when my daughter started to work at the age of 14, that was 3 years ago. And 3 years ago, she was just like, she entered one store, she got the job within 10 minutes. It was just like, hi, my name is Amy. Can I have a job here? Yes, you're starting to work tomorrow. Today, not that easy, especially if you're 14, right? So that is like a bit slowing down. The economy is slowing down. Unemployment rate is increasing. We have seen from many companies report that consumers are getting their budget a little bit tighten up. So Canadian Tires are telling us that, Home Depot, Nike, Starbucks, even McDonald's are just like, yeah, we have to bring back the $5 the $5 meal because now a lot of people are struggling and they're having a hard time even to afford cheap fast food. So we have to lower our price. So we see a bunch of promotion from Starbucks because they want to revamp their sales and so on. So we can tell that those companies are having a bit of a difficulty to generate growth, which overall, not necessarily a good sign for the economy and for the long run for the stock market. Probably not incredible news either. Of course, AI is going to solve all of this. So that's why the US market keeps on going like crazy. But when you look at that on a more paused way, well, we are trying to reach that smooth landing that Bank of Canada and the Federal Reserve in the US are still talking about, which means that they want to tame the inflation by increasing interest rates, but then lower the rates right before we get into a recession. That would be a perfect smooth landing. I don't even recall if it happens in the history, honestly. So I've been following the market for 20 years. Of course, I have not went into a high inflation period. During that time, it was like pretty much under control since I started investing in 2003. So this is not something that I've lived through, but even back in like the very strong inflation period of the 70s where the magical word stagflation appeared, that was not a smooth landing. That was like a very difficult decade, and it has been very rough, even in the 80s, for a lot of investors and a lot of consumers. So hopefully we're not going to get there. It seems that, I mean, if we do not have a smooth landing, we're going to have an okay landing. So that's good news. I'm still worried about the lagging impact of those interest rates because that will continue to have an impact going forward. But so far, the economy has been proven quite resilient. Even like, especially the housing market, I expected the housing market to go very, very bad. And even though there's a slowdown, not that bad. So overall, I mean, I like that I like the interest rate going down a little bit because I do have a mortgage, so I'm happy. And it will obviously be a little bit better for some companies. So that's the good side. But on the bad side, that's also a sign that the economy is not doing that well. So it's not a reason to cheer up, and it's not a reason to throw up a party. So my advice here, stay invested. I mean, it's super easy. I'm not changing my investment portfolio. I'm not changing any of my position because I think that those events are going and coming, and interest rate will always be part of the discussion. So with a solid plan and a solid diversification, you don't even have to mind. That's the beauty of it, right? So, all right, Moose, that's enough for today. I hope that you have enjoyed it. Tomorrow, we're going to talk about how much does it cost to keep your losers, and we're gonna talk about Algonquin specifically. Instead of like having clear investment rules, how much does it cost to just hold onto those losers until they recover? So, all right, we're gonna talk again tomorrow, and until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.